Hi, everyone. Welcome to today's deep dive. We're going to tackle some really fundamental questions today, like why do companies even exist beyond just, making stuff?
And, crucially, in the world we live in now, are they responsible for more than just turning a profit?
Exactly. So we'll be exploring the foundational economic ideas about firms, why they exist, how they're structured.
And then looking at how those ideas are really being challenged by, well, by the modern world, frankly, which leads us straight into this complex area of corporate responsibility.
So our mission today is pretty clear. Unpack the key insights from all this, give you a solid perspective on how thinking about firms has evolved and what their place is in society today.
Okay, let's jump right in then. If you look at the sort of the simplest traditional economic view, a firm is almost like a black box.
A black box, how so?
Well, it's seen just as a production function. Inputs go in labor, capital, whatever.
Right.
Outputs come out goods, services, and the owners. They're just assumed to agree on one thing, maximizing profits, pure and simple.
So a really stripped down model, no real focus on the people inside or how decisions actually get made.
Pretty much. And this simplicity, funnily enough, sparked a really big question from Ronald Coase way back in 1937.
Okay.
He basically asked, look, if markets are so efficient, why do we even need firms? Why isn't everything just people buying and selling from each other in the market?
That's a great question. And the flip side too, right?
Exactly. If firms are efficient, why isn't everything just one giant company?
So what was his answer? It must have been quite something back then.
It really was. He pointed out something that seems obvious now, but wasn't then. Using the market isn't free. It costs something.
You mean like finding suppliers, negotiating choices?
Precisely. Finding people, haggling over terms, making sure they stick to the deal, all that takes time and effort, these are transaction costs.
Ah, okay. Transaction costs.
And Coase's big idea was that firms exist because they can often do things cheaper than the market by reducing these transaction costs,
Mhm.
especially for repeated tasks or things needing coordination.
So instead of endless contracts,
You bring it inside, you have an employment relationship, you manage things through direction, not constant market haggling.
so the key takeaway from Coase is firms exist because markets aren't perfectly efficient. They have these costs.
Exactly. Firms are a way to get around those market inefficiencies. They're created to be more efficient than relying just on the market itself.
And that kind of bumps up against the simple Adam Smith invisible hand idea, doesn't it? The idea that self-interest in markets just automatically leads to the best outcome.
It does, subtly. Coase showed markets have friction. Later on, Garrett Hardin noted how Smith's idea contributed to this general feeling that individual choices just add up perfectly for society, maybe overlooking these frictions Coase identified.
Okay, but Coase still doesn't fully crack open that black box.
Yeah.
What about the people working together inside the firm?
Right, that's where Alkene and Demsetz came in, around the 70s. They focused on team production.
Team production, like when a group works on something, but it's hard to tell exactly who did what.
You've got it. Think of a group project. It's tough to measure each person's exact input. This creates a problem, what economists call moral hazard.
Meaning people might slack off a bit if they know they'll still share in the reward.
Exactly. How do you make sure everyone pulls their weight? Their answer was monitoring. You need a manager, someone to watch and measure effort.
Okay, makes sense. But then who watches the watcher?
The classic question, their answer. The monitor should be the residual claimant.
The residual claimant, meaning the person who gets what's left over, the profit.
Precisely. The owner or the shareholders, their incentive to monitor properly is built in because they get the profits that come from the team working efficiently.
So that gives an economic reason for the profit motive driving efficiency inside the firm.
Okay,
The core idea there. Teamwork needs monitoring, and owners are the natural monitors because they benefit directly from the profits.
got it. Now, this leads us towards Jensen and Meckling in 76, right?
Yeah.
They brought in something crucial, the separation of ownership and control. Yes, building on what Berlin Means had pointed out decades earlier. In most big companies, the people who own it, the shareholders, aren't the same people running it day to day, the managers.
And firms need money. They need capital from outside investors.
Right. So you suddenly have multiple groups with claims, shareholders wanting dividends and stock growth, creditors wanting their loans repaid. This creates much more complex governance problems. How do investors make sure managers act in their best interest?
And that's where we start seeing things like stock options for executives or using debt to keep managers focused.
Exactly. Jensen and Meckling provided the theoretical groundwork for why we have these mechanisms. Their work strongly supported the idea that governance should focus on aligning managers with shareholder interests. It really solidified the shareholder value paradigm.
But as you said, it immediately flags the question, what about the others, like the people who lent the company money?
Yeah, and that leads into Oliver Williamson's work around 1979. This next part's a bit intricate. He looked closely at the kinds of deals made inside and outside firms. Yeah. He argued that doing things inside a firm is often better because there's hopefully more shared interest, more cooperation, less of that self-interest with guile, basically, less trying to cleverly rip each other off.
Because contracts are never perfect, right? You can't write down everything.
That's his key point.
Yeah.
Incomplete contracts. You can't possibly foresee and write down every single eventuality. This leaves people open to being taken advantage of later.
Okay.
And he stressed that different stakeholders have different levels of protection.
How so? Different kinds of contracts.
Exactly. Think about a creditor, someone who lends money. Their contract is pretty specific. Get this interest payment by this date, get the principal back by that date. If things go wrong, they often have collateral they can claim.
Right. And employees?
Well, usually they can quit if they're unhappy.
Yeah.
But shareholders, their deal is wide open. No guaranteed return, no fixed payments.
They just hope the company does well and the stock price goes up, or maybe they get dividends.
Precisely. And crucially, if the company goes belly up, they're dead last in line to get anything back. If there's anything left after creditors, employees, everyone else is paid.
So they're the most exposed.
Williamson argued yes. Because they have the least contractual protection, they're the residual risk bearers. Therefore, he concluded, corporate governance should primarily focus on protecting them and giving them control.
Okay, so that really bolsters the shareholder-first view of governance, but we still haven't answered Kosi's other question. Why isn't there just one giant firm? What stops them from growing forever?
Good point. Grossman and Hart tackled that in the mid-'80s. They tied the limits of firm size back to those incomplete contracts again, but focused on relationship-specific investments.
Investments that are only really valuable within one particular business relationship.
Exactly. Like building a custom machine that only works for one specific customer. Once you've made that investment, you're kind of locked in.
And the other side might try to exploit that, the hold-up problem.
You got it. They might try to renegotiate the deal on worse terms, knowing you can't easily take your investment elsewhere. Grossman and Hart said property rights, who owns the assets, are key here.
Owning the asset protects you from being held up.
It gives you more bargaining power, stronger incentives to make that specific investment. But the flip side is, the party who doesn't own the asset might have weaker incentives to make their specific investments.
I see. So it's about who should own what.
Their general principle was, give control rights ownership to the party whose specific investments create the most value or are most vulnerable to hold up. It might be the investors, but it might be the workers, if their specialized skills are paramount.
So this was a big step, suggesting maybe governance shouldn't always be just about shareholders. It depends on the situation.
Yes, it opened the door to thinking about protecting various stakeholders, depending on whose specific contributions are most crucial. Deciding whether two firms should merge, for instance, depends on who gains the most protection for their key investments in the combined entity.
Which brings us nicely to Henry Hansman in the 90s. He looked at the real world, at all the different types of firms out there.
Right. He saw firms serving many groups, employees, customers, creditors, shareholders, and he noticed their legal structures vary, often reflecting which group's interests seem most central.
Like worker co-ops.
Exactly. Owned and run by employees. Often works well where workers have similar skills and can effectively monitor each other.
Or nonprofits, like universities or hospitals. No shareholders at all there.
Right. Run by boards focused on a mission, not profit. And then there's the most common form, the standard shareholder-owned corporation, the LLC.
And why did Huntsman think shareholder control is so dominant there?
His argument was largely about efficiency. He suggested governance works best when the group in charge has similar goals. Shareholders, he argued, generally agree on maximizing profit, which makes decision-making more straightforward than, say, trying to balance the often conflicting goals of employees, customers, and investors all at once in a shared governance setup.
So it's less about shareholders being inherently more important and more about it often being the most practical way to run things, especially when attracting investment capital is key.
That's a good way to put it. It's often the most efficient structure for making decisions and aligning incentives for certain kinds of businesses. Though, as you noted, variations exist, like systems with formal employee representation on boards, like in Germany.
Okay, so if we sum up part one, these classical theories build on each other. Firms exist to overcome market problems like transaction costs. Co's. They need internal structures for things like teamwork and incentives. Alki and Demsetz, Jensen and Meckling. Who needs protection depends on contracts and specific investments. Williamson, Grossman, and Hart. And different structures emerge based on efficiency and whose interests are primary.
Hmm.
But they mostly focus inwards, right? On efficiency, contracts, internal organization.
Pretty much. They didn't have a lot to say about the firm's impact on the wider world, on society, or the environment.
Which slams us right into the modern era, the Anthropocene, where human impact on the planet is undeniable.
And that's the massive piece missing from those classical frameworks. They generally ignored externalities.
Costs or benefits that aren't captured in the market price, like pollution.
Exactly. Pollution, climate change impacts, biodiversity loss, these weren't really part of the core economic model of the firm. The focus on market inefficiency was usually about things like transaction costs, not these huge environmental or social spillovers.
But today, with challenges like climate change, you just can't ignore them. It forces a rethink.
Absolutely. And this is where people like Hart and Zingals in 2017 came in with a really critical refinement. They said maybe companies shouldn't just maximize shareholder market value, but shareholder welfare.
Welfare, not value. What's the difference there? Sounds subtle.
It's huge, actually. It acknowledges that shareholders are people, too. They might care about things other than just the absolute maximum financial return.
They might not want the companies they own to pollute rivers, even if it saves money.
Precisely. Hart and Zingals argue that governments can't always regulate everything effectively or clean up every mess. So maybe shareholders themselves would prefer the companies they invest in to limit negative social or environmental impacts, even if it slightly reduces profits.
And if the owners want that, then the their fiduciary duty should arguably include considering those impacts.
That's the implication. It opens the door wide to the idea that shareholders aren't all identical profit maximizers. They might have different values, different preferences.
Is there evidence for that? That shareholders aren't monolithic?
There is. Bolton, Lai, Ravina, and Rosenthal found some compelling evidence in 2018. They looked at how big institutional investors, the huge pension funds, asset managers, actually vote on shareholder proposals, especially the ones about environmental and social issues.
The proxy voting records, those are public, right?
They are, in the U.S. at least. And by analyzing these voting patterns, they could see if investors showed consistent leanings, what they called investor ideology.
Like a political ideology, but for investment choices on these issues.
Kind of. Does an investor consistently vote for, say, climate disclosure proposals across different companies, or consistently against them? They found they could map investors and proxy advisors, the firms that recommend how to vote on a sort of spectrum.
What did the map show?
Clear differences. Some funds, particularly those labeled as socially responsible, consistently voted in favor of environmental and social proposals. Others, less so. Even the giant managers like BlackRock and Vanguard showed different voting patterns in the data they studied, suggesting different levels of concern, at least in their voting behavior at that time.
So the takeaway is shareholders are diverse. They don't all just want maximum profit at any cost. Their varying views on E&S issues matter for governance.
Definitely. It really challenges that old model of a single unified shareholder interest.
Okay, so if the traditional model is being challenged by externalities and diverse shareholder views, what about different types of companies? Are some structures better suited to this new reality?
Well, that brings us to foundation-owned companies, which Thompson and Hansman studied. Think of companies controlled not by shareholders, but by a foundation. It's quite common in places like Denmark.
Like Novo Nordisk, the big pharma company.
That's a prime example. These foundations often have a self-appointing board, meaning the board chooses its own successors, and sometimes they have a stated purpose that goes beyond just making money. Novo Nordisk's purpose explicitly includes fighting diabetes and other chronic diseases.
How do they perform financially compared to regular companies?
Generally, pretty well. They don't seem to underperform. But their structure might offer advantages in today's world.
How so?
Because foundations are often set up to exist forever, they tend to be very long-term investors. They might be less obsessed with quarterly results than companies listed on the stock market.
Less short-termism, more patient capital.
Exactly. That longer time horizon can make it easier to invest in social or environmental initiatives that might take years to pay off or that primarily deliver non-financial benefits. They might be structurally better suited to balancing profit with purpose. We see similar long-term mission focus in U.S. private universities run by boards of trustees too.
Interesting. So these modern perspectives are really pushing back on the narrow profit-only view. They're saying externalities matter, owner preferences are complex, and maybe different company structures are needed for the long haul.
Which leads us right to the core question. What exactly is corporate responsibility then?
Yeah, if it's not just obeying the law and making money, what else is involved? Where do you draw the line?
Well, the basic idea is that companies have obligations that go beyond just financial performance and legal compliance. They need to consider their impact on society and the environment.
Is this a new idea driven by recent crises?
Actually, no. People were grappling with this over a century ago. Maurice Clark wrote about it back in 1916.
Wow, 1916. What was his take?
Clark was writing when people were debating the balance between pure free markets and government control. He argued for a kind of middle ground. He thought businesses, and individuals too, should proactively figure out and meet their obligations before the law forced them to.
Before it becomes legally required?
Yes. He called it the twilight zone of obligations. Things that weren't yet demanded by law or custom, but where a responsibility still existed based on the known consequences of your actions.
Why did he think that was necessary?
His reasoning was simple. Law and custom can at best never keep pace with the needs. Things change too fast. If you know your actions have certain results, especially harmful ones, you have a responsibility for them, whether there's a specific law about it yet or not.
So anticipate what good regulation should look like and act that way anyway.
That's the essence of it. Don't wait to be forced. Since markets don't properly price social or environmental damage and governments are often slow, companies should step up.
Did you have a guiding principle for this?
He did. In 1916, he wrote, "The ideal is to pay one's way, not to hurt others without compensation, to get value only for value given, and to leave the world in other respects, just as one found it, or at least not to leave it the worse for one's presence."
That sounds incredibly modern, very close to sustainability.
It's remarkably similar to the Brundtland definition of sustainable development from 1987, meeting present needs without compromising the ability of future generations to meet their own. Clark was way ahead of his time.
Amazing. Did he say anything else relevant?
He also worried that as share ownership became widespread and distant, investors lost connection with the actual businesses, focusing only on the money-making aspect. He felt a vital social interest was lost, and even questioned if limited liability protecting owners from company debts went too far in detaching responsibility.
Okay, so the idea has deep roots, but still, that practical question remains. If responsibility goes beyond law, how far does it go? Who decides?
That's the challenge Lee Preston and James Post addressed in 2012. They asked fundamentally, what are the limits of corporate responsibility?
Because it can't be infinite, right? A company can't solve world hunger.
Exactly. Their point was, no firm can be responsible for everything, but equally, no firm can expect society to hold it responsible for nothing. It's about finding a reasonable scope.
Based on what the company actually does.
Yes, they talked about primary involvement, the core business activities a firm chooses, like making cars, and secondary involvement, the impacts that flow from those activities, like factory emissions or the safety of the cars. Responsibility should relate logically to these involvements.
And they noted that big disasters often shift where society draws that line.
Right. Events like Bhopal, Exxon Valdez, Deepwater Horizon, they force everyone, including companies, to rethink what's considered acceptable risk and responsibility.
But there's a danger of the scope becoming too broad, too vague.
Absolutely. Look at the UN Sustainable Development Goals, 17 goals, 169 targets. Hugely important globally. But if a company tries to claim it's addressing all of them, it becomes meaningless. You risk diluting effort and achieving very little. Firms need to be clear-headed about their specific impacts and draw lines there.
So, summing up, corporate responsibility means acting ethically beyond the bare legal minimum, operating in that twilight zone Clark described, basing actions on actual impacts, drawing careful lines, and really connecting historical ideas about business ethics to today's sustainability challenges.
Which brings us squarely to the practical side. How do companies actually do this? How do they define those lines? Especially when their shareholders and society might have very different ideas about what's important.
Let's think about some concrete, maybe tough examples. Where might a company choose to act responsibly, perhaps even if it hits the bottom line in the short term?
Okay, consider fossil fuel companies. One potential action, anticipating climate regulation or just acknowledging the impact, could be to voluntarily stop exploring for new oil and gas reserves, as activist groups urge.
Or maybe, instead of paying out big dividends, they could reinvest all profits into building renewable energy capacity.
That's another possibility. Or think about food and beverage companies and plastic waste. We know companies like Coca-Cola, PepsiCo, Nestle produce enormous amounts of plastic packaging annually.
Millions of tons, based on their own disclosures a few years back.
Right. A responsible move could be to proactively design out single-use plastic, finding alternatives, even before regulations mandate it everywhere.
And what about the investors themselves, the big institutions?
They could take initiative, too. They can decide, based on their own analysis of long-term climate risk or ethical considerations, to divest from fossil fuels entirely, even if those stocks are performing well right now.
These are all tough choices because they pit potential long-term benefits or ethical stances against immediate financial metrics.
Exactly. And the situation with Berkshire Hathaway and climate responsibility really throws this conflict into sharp relief.
Warren Buffett's company. Huge, diverse holdings, including major energy utilities.
And consequently, one of the world's largest corporate emitters of greenhouse gases. It's been specifically targeted by investor groups like Climate Action 100 Plus, pushing for climate action.
But Buffett, who controls a large chunk of the votes, has consistently resisted shareholder proposals on climate, right? Like requests for more disclosure or setting emissions targets.
That's correct. He's blocked them repeatedly. This has led to some significant pushback. Norway Sovereign Wealth Fund, a massive global investor, actually voted against re-electing Berkshire's board members because of this refusal on climate disclosure.
And proxy advisors, the firms guiding other investors.
ISS, a major one, recommended voting against the lead independent director, specifically citing the company's huge emissions and lack of basic steps to mitigate climate risk.
How is Buffett's position usually described?
Often as intransigent on climate, commentators have highlighted his focus on traditional business savvy and what's described as an owner, not stakeholder orientation. The message often seems to be that profitability is the social good, aligning with some anti-ESG arguments. The idea that focusing on anything else distracts from the core business mission.
But is that view holding up against reality? Are there tangible climate risks hitting Berkshire?
Well, yes. The real world is intruding. Pacificorp, one of Berkshire's big electric utilities, has faced potentially billions of dollars in losses related to wildfires in recent years.
Wildfires linked to climate change.
That's the increasing concern for utilities across the western U.S. and elsewhere. We saw Pacific Gas and Electric in California go bankrupt, over $30 billion in wildfire liabilities. And if you look at Berkshire's own reported earnings for its U.S. utilities, there was a noticeable dip in after-tax earnings in 2023 for the group, including Pacificorp, NV Energy, and Mid-American Energy. The trend line definitely took a hit. Climate risk isn't just theoretical, it started to show up in the financials.
So the case really crystallizes the tension between that traditional profit-first mindset and the unavoidable physical and financial risks of climate change, demanding a clearer stance on responsibility.
And it comes back to a fundamental ethical question, doesn't it? If you ask most people, is it okay to pursue your own benefit while knowingly causing significant harm to others without trying to mitigate it?
Most people would say, no, that's unethical. We expect people to consider the effects of their actions on others, not just their own wallet.
Right. So the crucial follow-up question is, does that basic ethical responsibility just evaporate when someone acts through a corporation instead of as an individual?
The implication seems pretty clear.
It seems obvious it doesn't. Those responsibilities don't just disappear behind a corporate veil. And that's why this whole concept of corporate responsibility isn't just some optional extra. It's becoming a central, urgent governance issue, especially with the global challenges we face.
And the most responsible approach, echoing Clark from over 100 years ago, might be to anticipate what society needs companies to do, what effective regulation would look like, and act accordingly, proactively.
Instead of just waiting for the regulators or a crisis to force your hand.
Wow, that was quite the journey. We started way back with the basic economic questions: why do firms even exist?
Yeah, looking at transaction costs, team production, ownership control, all focused on overcoming market problems and achieving internal efficiency, often landing on shareholder value as the goal.
And then we saw how that traditional view is getting seriously challenged by the scale of modern problems like climate change. The externalities those early theories largely ignored.
leading to ideas like shareholder welfare, recognizing diverse owner preferences, and looking at alternative structures like foundation ownership that might handle long-term, broader goals better.
Which brought us to defining corporate responsibility itself, moving beyond just legal compliance, acting proactively in that twilight zone, drawing lines based on real impacts.
And connecting those very modern challenges back to ethical principles people were debating a century ago.
The core tension is palpable throughout, isn't it? That established focus on financial return versus the growing pressure for environmental and social accountability.
And that fundamental ethical question, do our responsibilities change when we act collectively through a company?
So, reflecting on all of this, the power corporations wield, the scale of the challenges, it leaves a big question for you, the listener. Where do you think the line of corporate responsibility should ultimately be drawn?
It's something we'll all be grappling with for a long time to come.
Thanks for joining us for this deep dive.
Until next time, keep exploring.